Hello, everyone, and welcome back to the Deep Dive. I hope you are having a productive week, and we are absolutely thrilled to bring you another high conviction analysis today. Today, we are cracking open the vault on Fidelity National Information Services, or FIS. Now, if you are a long-term investor, you know this name. It is one of the largest and frankly one of the least understood players in the global fintech ecosystem. This is the company that provides the essential, secure technology, the plumbing for the world's biggest banks, their capital markets divisions, and how they handle payments. Here is the central question we are tackling. For years, FIS has been seen as this, complex, debt-laden conglomerate wrestling with the fallout of huge acquisitions and undergoing some painful restructuring. But the management team has executed a massive strategic pivot, selling off a huge piece of the business and committing to aggressive deleveraging. Is this pivot successfully revealing a fundamentally high-quality, high-moat infrastructure asset that the market is currently mispricing? That's what we're here to find out for you today.
That is a massive question, and one that, it requires us to look past the noisy headline restructuring and really focus on the enduring nature of the core business that remains. But before we get into details of the financial fortress, just a quick note for everyone watching.
For those of you who want to act on these investment ideas, having a professional-grade platform is key. We use interactive brokers for our deep analysis, and we've partnered with them to get our viewers a stock bonus when they sign up. It just gives you the tools you need for serious, professional-grade research.
Exactly. So you get that bonus for using a fantastic platform, and you simultaneously support the channel so we can continue bringing you this level of analysis. That link is right there in the description below this deep dive.
That's right. And of course, if you find value in this kind of in-depth discussion, and we believe this is one of the most complex analyses we've done this year, the best way to let us know and to get the next one delivered straight to you is to hit that subscribe button and like this deep dive. It truly helps the channel grow. And if you have any pressing questions regarding FIS or its competitors, please engage with us in the comment section.
Perfect. Now let's get into it. We need to start by grounding ourselves in the quality of the core asset because, look, without understanding the core, the strategic pivot makes no sense. Pillar number one, the business model and competitive fortress.
Okay, let's unpack this. We called FIS the plumbing, and that sounds boring, but in finance, boring often means reliable. What exactly is the core function they provide that is so indispensable to global banks?
They're the central nervous system. When we talk about core function, we mean the mission-critical technology, the ledger systems, the software interfaces, the processing engines that allow financial institutions, FIs, to function. This isn't marketing software. This is the general ledger.
The guts of the operation.
The guts. It's the compliance reporting engine, the deposit account processing system, and the lending platform. Consider a major commercial bank. Every single transaction, every dollar that moves, every calculation of interest, every regulatory report required by global mandates, all of that relies on the accuracy and the stability of FIS systems. They provide three main slices: core banking, payments processing tech, and capital markets operations support.
And this leads directly to what you called the sticker shock quality of the revenue. It's not just recurring, it's basically non-discretionary. How high is that retention rate, and what mechanisms ensure they keep getting paid?
The client retention rate is stunningly high. We're talking over 95%. And this isn't based on some optional SaaS subscription that a bank can just cut when times get tight. This revenue is generated through long-term service contracts, maintenance fees, and transaction processing volumes. If a bank wants to open its digital doors in the morning, it must continue paying these fees. The payments are simply an essential operational cost baked into their budget years in advance.
So if some of the technology is complex and, let's be honest, decades old in some cases, why is its enduring relevance so certain? What structural trends are ensuring FIS's longevity?
There are two tectonic forces at play here. First, you have the irreversible global shift to digital and mobile banking. Every single FI needs to modernize to offer competitive, fast digital experiences. Their legacy core systems simply cannot handle the speed or the volume.
They weren't built for it.
Exactly. And second, and this is crucial, the complexity of regulatory compliance. Banks realize they cannot handle the necessary core system upgrades and the exponentially growing regulatory burden themselves. It's just too costly, too specialized, and way too risky.
So they outsource the risk?
They outsource it. They hand that core transformation to massive, trusted vendors like FIS. FIS essentially absorbs the operational and regulatory risk for the bank.
You know, the genius of this model is its simplicity at the highest level. It enables fundamental human behavior. We will always save, borrow, and transact. FIS just digitizes the infrastructure for it.
Exactly. And that connection to fundamental, enduring economic behavior provides stability few industries can match.
Hmm.
The high cost and massive risk involved in changing these providers ensure that FIS's relevance isn't measured in quarters, but in multi-decade partnerships.
Okay, so for the investor watching this, why should we care so much about this predictable revenue stream?
Well, it creates a foundational resilience in the investment case. When 95% of your revenue is guaranteed, long-term, and non-discretionary, your business possesses an incredibly robust baseline.
So even in a downturn?
Even during economic downturns, when discretionary IT spending freezes, the bank still has to pay FIS to function. This reliability provides management with dependable cash flow for sustained R&D, something that smaller, more volatile players just cannot match.
I think we can agree the competitive advantage here is almost entirely focused on high switching costs. But how do we move beyond that term and quantify just how powerful this moat is in the real world?
We quantify it by looking at the cost, the time, and the risk. The primary moat is so deep because the software isn't just a tool. It is the operational skeleton of the bank, and that skeleton is fused with the bank's own internal processes.
Can you give us a concrete example?
Sure, let's use their core system, Profile. If a large bank uses Profile, we are talking about hundreds of internal systems integrated with it. Fraud analytics, their proprietary lending models, the ATM network, the teller systems, the data architecture required for Basel reporting, everything is reliant on that core FIS system.
So if the bank wanted to migrate away from that, what are the mechanics involved? I mean, it's not just installing new software, right?
Not even close. It's an active institutional surgery. The expense of a migration is vast. We're talking hundreds of millions, sometimes billions, in integration costs alone. But the cost is actually the secondary deterrent.
What's the primary one?
The risk. The risk of system failure. Any failure during migration, a data integrity issue, an outage, a lapse in compliance reporting, can trigger an existential crisis for the bank.
And regulators would come down on them like a ton of bricks.
Immediately, particularly in the US and EU, they will impose massive fines. For a Tier 1 bank, that risk exposure often outweighs any potential cost savings a new vendor might offer. It's just not worth it.
I've heard these projects for a full core replacement can take years. What kind of time horizon are we talking about for a major institution to change its core processing system?
For a global bank, you are looking at 5 to 10 years.
Wow.
5 to 10 years of internal disruption, testing, dual running systems, and enormous internal headcount focused on just that one project. To put that time frame in perspective, that's often longer than the tenure of the CEO who initiated the project.
That's incredible.
And this immense time commitment, coupled with the systemic risk, creates active deterrence. This is what allows FIS to maintain rational pricing power on services that the client is fundamentally locked into.
Now, looking forward, is the moat stable, or are there cracks appearing with all the new fintechs out there?
Our analysis points to the moat being stable to widening. And that might sound counterintuitive, but two factors favor the incumbents. First, global regulatory pressure is intensifying, especially around capital adequacy and liquidity, like new Basel requirements.
Which makes things more complex.
Way more complex.
Mm-hmm.
And the complexity of integrating these new compliance engines into a core system raises the barrier for any new competitor.
Mm-hmm.
Second, the sheer demand for R&D into digital features, AI integration, and cybersecurity is massive.
So it's a scale game.
It's a huge scale game. Only large cash-rich incumbents like FIS can afford to sustain the $1.5 billion plus R&D budgets needed to keep up, which pushes the barrier even higher for smaller entrants. The larger the bank, the deeper the moat.
Let's bring in a mental model that frames this investment perfectly. Tollbridge economics, famously championed by Buffett and Munger. How does FIS perfectly embody the characteristics of a toll bridge?
Well, a toll bridge sits at a critical choke point where traffic is non-discretionary. FIS owns those bridges in the financial system. They are the essential link between a bank's internal structure and its ability to serve customers and comply with the law.
So the institutions have to pay the toll.
They have to pay the toll. But how does FIS exercise that pricing power in practice? It's not just an arbitrary rate hike. They use two main mechanisms: annual inflation escalators built into long-term contracts, and mandatory fees associated with required regulatory updates.
Ah, okay. So if the government mandates a new compliance requirement, say related to instant payments or new capital calculations, the bank has no choice but to adopt FIS's updated software module to comply.
Precisely. And that update, the service and the implementation, comes with a fee. This guarantees revenue growth tied not just to transaction volume, but also to the ever-increasing complexity of the financial system. It guarantees predictable cash flow, which is arguably the most valuable characteristic of a world-class business.
But the flip side of that is the industry context. They are not a true monopoly.
Absolutely not. They are a regulated oligopoly, and we need to understand the nuances of the competitive friction.
Okay, let's break down the competitive landscape. FIS is one of the big three, sometimes the big two, depending on how you categorize. How does FIS differentiate itself from its closest peer, Fiserv, FISV?
The differentiation is significant, especially now, post-divestiture. Fiserv has a massive presence in merchant processing, which is generally a higher volume, lower margin business with different capital expenditure requirements. FIS, having shed Worldpay, is now far more focused on the core banking and, critically, the capital markets segment.
And what does that capital markets piece give them?
That capital markets business supporting large global investment banks, asset managers, brokers, it gives FIS a diversified revenue base that's less reliant on the commercial banking cycle. This segment requires extreme specialization, compliance expertise, and high service levels, which just further reinforces those switching costs. Fiserv is strong, but their focus is less diversified into that Tier 1 global capital system than the newly focused FIS.
And what about Jack Henry, JKHY? Where do they sit in all this?
Jack Henry is a quality operation, no doubt, but they are focused almost exclusively on the U.S. market, serving community banks, credit unions, and mid-sized institutions. While they have excellent API integration and customer loyalty, FIS's scale advantage lies in its ability to serve the largest, most complex, multinational Tier 1 and Tier 2 FIs.
The Deutsche Banks and Barclays of the world.
Exactly. The entities that need global reach and extremely specialized solutions. FIS excels where complexity is highest.
Then we have the disruptors, the
Right.
cloud-native fintech startups like Temenos, Q2, and various core-as-a-service providers. Their pitch is simple: rip out the legacy system and replace it with modern API-first architecture. How is FIS defending against this existential threat?
FIS's defense is twofold. First, they rely on that immense regulatory inertia we discussed. Trust is slow to build, and no bank wants to be the guinea pig for a new, unproven core.
For sure.
Second, they are proactively meeting the threat through their $1.5 billion R&D bet, the cloud-native componentization strategy.
What does that mean in simple terms?
It means they are breaking their monolithic, decades-old code base into smaller, modular components that can be deployed independently in the cloud. A bank doesn't have to rip out the entire system. They can replace just the deposits module or the lending module with FIS's new modern component. This allows them to offer modernization piece by piece, relying on their existing relationship and installed base as the anchor. It's a very smart defensive and offensive play.
That makes a lot of sense. But let's turn to the scuttlebutt insights, the friction points that don't show up on the revenue line. We talked about customer bargaining leverage and employee sentiment.
Yes. So while the switching costs are high, the customers are giant, sophisticated, multinational financial institutions. They're not captive in a passive sense. They exert immense bargaining leverage during contract renewals.
So FIS can't just price gouge.
No, they must deliver innovation and service quality to justify their fees, which definitely caps margin expansion potential. And the second point is that below-average employee sentiment. A comparably score of 69 out of 100 and low internal morale, that's a worrying operational friction.
Where does that come from?
It often stems from the cultural issues and messy integrations of historical acquisitions like SunGard and Worldpay. If management cannot fix this cultural toxicity, it translates to slow decision-making, difficulty attracting elite engineering talent, and eventually degraded client service. Poor culture is the subtle friction that can erode a client relationship over a decade.
That cultural baggage leads us directly to Pillar 2, the history of M&A, specifically the $43 billion Worldpay acquisition, which created this overhang. Why exactly did that integration fail so badly?
It failed because it was a collision of cultures, business models, and capital structures. Worldpay was a high-growth, high-volume merchant acquiring business, a business that required constant high capital expenditure, CapEx, investment in terminals, and point-of-sale infrastructure.
And FIS's core business is the opposite.
Completely. FIS's core banking business is low-growth, high-margin software services asset-light, needing R&D, not hardware CapEx. They have different sales cycles, different regulatory environments, and fundamentally different financial profiles.
A mess.
A total mess. The complexity of running those two divergent businesses under one roof created immense management drag, prevented necessary focus on the high moat core, and resulted in a staggering debt burden. It was a classic example of M&A focused on size over synergistic returns.
And here's where I have to inject some skepticism. Many of the executives involved in that era are still senior leaders. The CEO, Stephanie Ferris, has led the charge on the pivot since mid-2022. Why should investors trust this management team's capital allocation philosophy now, given that recent history?
That is a critical question, and it's why the $11.7 billion Worldpay divestiture was so critical. It was an admission of error and a declaration of a radically different philosophy. Ferris's future-forward strategy isn't just buzzwords. It represents a hard pivot toward an owner-oriented mindset focused on driving high return on invested capital, or ROIC.
So what does that mean in practice?
Operationally, future-forward means simplicity. Streamlining hundreds of product lines down to a standardized, focused core offering, ruthlessly cutting costs in non-core areas, and most importantly, dedicating capital only to the highest moat, stickiest parts of the business. The sale wasn't just a divestiture. It was a simplification and a refocusing exercise to reveal the quality asset underneath all that mess.
Let's detail the current capital allocation strategy, which is leveraging that $11.7 billion cash influx.
The strategy is highly disciplined and addresses the company's biggest weaknesses first. It's a three-pronged attack. First, that crucial $1.5 billion R&D investment into those cloud-native, componentized core solutions we discussed. This is existential spending to maintain the moat.
Okay.
Second, and this is the highest priority for the divestiture cash, is aggressive debt reduction. They have stated clearly that debt reduction is the non-negotiable step to provide stability and reduce interest costs. And third, once the debt targets are hit, they are signaling shareholder confidence with an increased share repurchase target, aiming for about $1.3 billion targeted in 2025. This entire plan is designed to transform the balance sheet from fragile to fortress-like.
Let's look at the financial results that reflect this history. If the core revenue is so stable, why is the reported GAAP net income so volatile?
It's the cost of the cleanup. The reported volatility in GAAP net income over the last decade is heavily influenced by the accounting consequences of aggressive M&A. When you buy massive companies using large amounts of debt, you generate goodwill. When those acquisitions fail to deliver the expected synergies, you have to write down that value.
Which results in massive impairment charges.
Massive non-cash impairment charges. This is exactly what happened with the Worldpay goodwill. Those multi-billion-dollar write-offs caused GAAP net income to swing wildly, masking the true stability of the underlying cash-generating capability of the core banking segment. The remaining core business, now cleaned up, should show significantly improved future earnings consistency.
This brings us to the historical scar, return on invested capital, the ROIC. The reported GAAP ROIC is shockingly low, around 5.6% LTM. That is not a number that screams high-quality business, and it's the biggest barrier for new long-term investors.
You are absolutely right, and this is the metric the management must fix. The low reported GAAP ROIC is almost entirely dragged down by the sheer volume of historical goodwill remaining on the balance sheet from the Worldpay and SunGard transactions. Those past capital allocation mistakes permanently scarred the tangible value.
So is there a better way to look at it?
Yes, this is where we need to look deeper at the normalized ROIC. This figure, calculated by analysts to strip out those specific non-cash impairment charges and normalize the goodwill, sits significantly higher, around 11.6%.
Which is better, but still not amazing.
It's not world-class, not yet. But it tells us that the current core operations are generating solid returns on the capital actually being deployed today. The key focus of management is driving this 11.6% normalized figure toward the 15 to 20% range through operational efficiency and focused R&D.
Now, a positive indicator. Free cash flow, or FCF, strength. They are targeting over 85% FCF conversion from net income. What does FCF conversion mean for a software business, and why is that target so powerful?
FCF conversion is the ultimate test of business quality. It tells you how reliably the earnings reported on the income statement translate into actual usable cash in the bank. For a software service business like FIS, the conversion is high because the business is asset light.
Right, they're not building factories.
Exactly. They require minimal ongoing capital expenditure, CapEx, to maintain their systems, unlike a manufacturing business or utility. High FCF conversion means that every dollar of net income is highly reliable cash flow, which is crucial for funding that $1.5 billion R&D bet and, more immediately, for paying down that crushing debt load.
And speaking of debt, the elephant in the room, The leverage. Net debt to EBITDA is currently 4.46 times LTM. Why is that level so dangerous for a technology services company?
In the software and asset-light technology service world, the benchmark for safety is typically a leverage ratio between 2.5 and 3 times net debt to EBITDA. A ratio of 4.46 is highly leveraged. It indicates financial fragility.
What does that mean in practice?
What it means is that the high interest burden consumes an inordinate amount of SCF, starving the R&D budget. In a high leverage, high rate environment, the margin for error shrinks to zero. Management has to execute the Worldpay divestiture cash deployment perfectly to bring that number down decisively. It is, without question, the single most critical near-term constraint on the company's operational and valuation potential.
Okay, let's pivot to Pillar 3, valuation, risks, and catalysts. Let's discuss the stock price. FIS trades at a distinct valuation discount compared to peers like Fiserv, despite owning similarly sticky assets. What is the market narrative that causes this discount?
The market narrative is simple, persistent, and backward-looking. The market sees FIS as a struggling, complex financial conglomerate that failed in its M&A strategy. It trades cheaply because investors are factoring in the risk of operational execution, the high cost of debt, and the history of subpar capital allocation demonstrated by that low reported ROIC.
So it's being misidentified.
Completely. The stock is not being priced as a pure-play, high-moat infrastructure provider, even though that is what it is rapidly becoming. The market is pricing the history and the complication, which results in lower multiples, lower PE, lower price to sales than what the underlying quality would otherwise dictate. This mismatch is the core investment opportunity.
When we approach an investment like this, high quality, high complexity, where do we find Benjamin Graham's promise of safety of principle?
The safety of principle is derived from the replacement value of the core asset. The intrinsic durable value of the software systems that run global Tier 1 banks is immense. No one could build those systems today for the current market capitalization of FIS.
So the replacement cost is a floor.
It's a substantial floor under the business. The satisfactory return is then found in the closing of that valuation discount. The market is still skeptical, pricing the stock based on the assumption that management might fail to execute the deleveraging plan. If management simply meets their stated goals, the discount should narrow, generating the necessary return.
So as investors, we should be looking for two specific moments to enter.
Exactly. The first is a broad market panic, a major correction that allows us to buy these already discounted, sticky assets at an even cheaper price. The second is a company-specific, temporary setback, an earnings miss that doesn't damage the long-term deleveraging trajectory or the moat's stability. We want to buy the uncertainty, provided the strategic focus on reducing debt and improving ROIC is unwavering.
The Worldpay distraction is gone. So what is the key to accelerating organic growth and margin expansion for the core business now?
The growth engine is twofold: the non-negotiable digital modernization cycle and FIS's R&D product strategy. Large FIs must modernize their core systems to handle digital traffic, AI integration, and instant payments. This is mandatory spending.
And FIS is positioned to capture that.
Perfectly. Their specific growth strategy, that componentization approach, allows them to cross-sell new modules into their huge existing installed base. They already have the relationship, the regulatory trust, and the deep system integration. Convincing an existing client to upgrade a specific module to the new cloud-native architecture is a significantly easier sale than rip and replace.
Which leads to faster growth.
Faster organic growth and margin expansion as they deploy more modern, efficient software.
Let's turn to the negative, the risks that could permanently impair shareholder value. The triple threat. Start with core disruption.
Core disruption is the primary existential risk. It's the scenario where the switching cost moat finally fails. This would happen if a well-capitalized competitor, maybe backed by a hyperscaler like Google or Microsoft, or a dedicated fintech giant, manages to build a core-as-a-service model that is demonstrably safer, regulatory approved, faster to deploy, and significantly cheaper.
And if that happens?
If that happens, it could trigger a multi-decade cycle of rip and replace, slowly eroding the incumbency advantage of FIS.
Okay, the second threat is regulatory and monopolistic intervention.
Right. Since FIS, Fiserv, and a handful of others control the core banking infrastructure for most of the Western world, regulators view this concentration as a systemic risk. We could see mandated measures to reduce vendor stickiness, perhaps requiring more standardized open APIs for data portability.
Or even price caps.
The extreme case would be regulatory intervention to cap service pricing, which would directly limit FIS's ability to generate value from its monopoly position. We have to watch for political will to intervene in these concentrated markets.
And the most immediate, critical risk, failure to deliver.
If management fails to hit its debt reduction targets, say, if organic revenue growth disappoints or interest rates rise further, the high interest burden becomes a permanent constraint. FIS risks becoming a capital-constrained zero-growth utility company. They would be unable to afford that necessary $1.5 billion in R&D to fend off competitors.
And in tech, if you're standing still, you're falling behind.
Exactly. And that path leads directly to permanent shareholder impairment.
Let's pivot to the positive triggers. What events, if they happen, will force the market to stop valuing FIS as a messy conglomerate and start pricing it as a pure-play infrastructure asset?
The most immediate catalyst is hitting the debt milestones. Achieving the net debt to EBITDA ratio decisively below 3 times, coupled with obtaining or strengthening a solid investment-grade credit rating, signals the successful completion of the strategic pivot. This removes the financial fragility narrative and should instantly trigger a significant re-rating of the stock toward peer multiples.
It's the second catalyst.
The second major catalyst is validation of the new growth engine. We need to see concrete proof that the componentization strategy is working. This means landmark new sales of the modern core platform. If FIS secures just 1 or 2 massive Tier 1 global financial institutions as clients for their new cloud-native componentry, it validates that $1.5 billion R&D bet and proves the organic growth engine is fully engaged.
It silences the doubters.
It silences the doubters who believe the company is just stuck with legacy sales.
All right, Pillar 4. We've covered immense ground. Let's crystallize this into the bull case. The reasons to own versus the bear case, the reasons for caution.
The bull case rests on 4 sturdy pillars. First, the high switching cost moat, which operates as Tollbridge economics, guaranteeing high recurring, sticky revenue from the largest global banks. Second, the management strategy is clear, rational, and focused on value creation through simplification, debt reduction, and strategic R&D.
Third and fourth.
Third, the business is a strong free cash flow generator with an 85% plus conversion target providing the fuel for the turnaround. And finally, the current valuation is depressed, offering a tangible margin of safety on extremely high-quality core assets.
And what are the primary weaknesses that justify the current discount, the bear case?
The bear case hinges entirely on execution risk and history. Number 1 is the non-trivial debt load, currently sitting at that 4.46 times leverage. Second, the historical capital allocation has been proven subpar, leaving a low JAP ROIC scar that undermines investor confidence.
And the competitive threats.
All right. Third, there is the risk of a slow, creeping erosion of the core banking market by better capitalized, cloud-native competitors. And finally, that subpar employee culture could impair the company's ability to attract and retain the elite talent needed to successfully execute this complex digital transformation.
In investing, it's not enough to be right. You have to be right when everyone else is wrong. We know the consensus narrative. FIS is a struggling, debt-burdened conglomerate in fix-it mode. What is the contrarian insight that we've derived from this deep dive?
The contrarian insight is that the market is misidentifying the underlying quality of the asset. The intrinsic durability of the deeply embedded banking and capital market software was merely obscured by the massive failed Worldpay acquisition. The strategic divestiture has effectively unlocked a pure-play, high-moat, fintech infrastructure business, removing the complexity that scared away growth investors.
So we're betting on the cleanup.
We are betting that management can successfully execute the financial cleanup, and that the stock is currently trading at a significant discount based on its past failures, not its future potential as a simplified, mission-critical provider. A re-rating will happen as the narrative shifts from restructuring mess to stable technology utility.
We have to challenge our highest conviction point, which is the durability of the moat. Let's run the red team challenge on this premise. The moat is an illusion, and the debt is real.
This is the ultimate risk inversion. We are relying heavily on the idea that switching costs keep customers captive. But let's assume those new cloud-native competitors finally overcome the trust and regulatory hurdles. If a simplified core banking solution emerges, that is superior in every way.
The contracts become liabilities.
The long-term contracts stop being assets and become long-term liabilities because they require costly defensive maintenance and offer little growth potential. If that core disruption scenario begins to unfold, and simultaneously, the organic revenue growth fails to accelerate as management expects, if it stays perpetually stuck in the low single digits, the high debt load becomes a death sentence.
Meaning
FIS becomes a capital-starved utility. The company needs massive R&D to survive, but the interest payments on the debt consume all the available free cash flow. They can't invest, they can't grow, and their technology slowly lags, eventually leading to permanent impairment of shareholder value. This tension between the undeniable durability of the infrastructure and the fragility of the financial structure required to maintain it is what investors must monitor closely over the next 18 to 24 months. Connecting this analysis back to you, the investor, the key takeaway here is that you are buying a proven, durable business model that is burdened by its own history. The pivot is rational, but the execution risk is non-trivial.
That is the perfect encapsulation. And here is the final provocative thought we want to leave you with, building on that tension. FIS has committed $1.5 billion to develop that new cloud-native componentized platform. If that new platform were to secure just one major, influential Tier 1 global bank client, a client that is currently using a competitor, how rapidly would the market be forced to re-rate the stock, effectively proving the value of that R&D bet?
That single contract news, showing that the core product can win against the competition, would be the catalyst that forces the narrative shift. We encourage you to track the news flow related to major core banking contract announcements, particularly in Europe and North America. That will be the validation point that tells you whether the financial cleanup is actually leading to a renewed growth trajectory.